Hello, everyone. I am waiting on Walmart to fix my groceries. It ordered it in a city very, very far away, so I had to move the order. I thought while I'm kind of waiting on that, and I'm waiting to start work, I would go ahead and talk about the economy absolutely destroying itself, and for lack of a better way to put it, pooping a ton of bricks. Okay. So I'm going to go ahead and share my screen and we will talk about this. Let's go ahead, share screen. I'm going to minimize Zoom because I probably get some sort of weird thing. All right, so let's go over this, right? I've covered some of this before. I've tried to um, flush out a lot of that thinking, okay? So we're going to start off with this one right here, which is what a lot of people in the Wall Street Silver subreddit talk about. So we have the M3 money supply, okay? And this is the Federal Reserve's number for how many dollars and some other similar cash equivalents are in the economy. Look at this, right? It's going off of a cliff. And the thing is inflation generally follows with some other variables this curve, okay? So compared to what, March of 2020 to May of 2020. And I mean, that was the COVID thing. That was to like bail out big businesses. Most of that money went to big businesses. Everyone knows that. The payment protection plan, like big banks were charging interest rates on that to for regular people to get it. So it's like you would be like, oh, help my business. And big banks would be like, oh, I'll take 10% of that before I give you it. It's shenanigans. Anyhow, we had $2 trillion printed because of, I mean, is that more than trillion? Yeah, it's trillion. $2 trillion printed because of COVID. Okay, fair enough. Definitely led to more bubbling in the economy. And we're still seeing that trend go ridiculously higher than it has been before. I mean, it's so bad, right? It's so bad that if you look at like quantitative easing in 2000, what, like 2008, you can't really even see it. Like maybe that's quantitative easing, like a nice little bubble there, which back then people were freaking out. And now look at this, right? It's like, oh Lord, right? That is the end of the economy, okay? As we know it. Let me talk about what happens when something like that happens, right? Inflation will kick off. You end up with a situation like Venezuela, where oil prices crashed, right? Because their economy was very dependent on that, and they started printing a lot of money, and you had hyperinflation. Like, here you go. That's literally just money in the street. People literally went to other countries like Colombia because their currency was freaking worthless and it destroyed their economy. Okay. And it's easy for Americans to be like, oh, that's not a big deal. Like, we've never had to deal with that before. And it's like, yeah, we've been very just kind of complacent in that sort of scenario. And it's like, it's happening. You can bury your head in the sand about it. I talk to people about this, and a lot of people are like, oh, like, well, my retirement advisor says I'm fine. And hey, I have to say I'm not a retirement advisor legally, but it's like, if your retirement advisor is not making inflation plays right based on this data, then they don't know what the hell they're talking about. And it's crazy. I've talked to my parents about this, and it's like, oh well, our advisor says we're okay. So like, let me tell you, right? Let me tell you what's going to happen in 6 months to 2 years. Okay. Inflation kicks off big time, right? I'm going to go to our next thing real quick. And it's, well, so here's Weimar Germany in the 1920s. After World War One, their economy was in shambles, obviously. And they printed so much money that kids were stacking it and using it as firewood. And it's like, this would maybe buy you a loaf of bread, right? Same thing in Venezuela. You couldn't use the money for anything. It wiped out everything. Okay. Now in Venezuela, if you had invested in silver, you actually would have been a lot better off once things stabilized. Okay. The only move in that context was essentially silver. Okay. Or commodities, but silver is cheap relative to other commodities. Okay. Um, I found some interesting things. I didn't like this one. Hold on. There is this article that's called the Shadow Government Statistics. Now, I don't necessarily feel the most comfortable putting this out there, but I generally agree with its sentiments. So I haven't checked their numbers. I haven't checked how they're calculating what they are. But what their argument is in this article, and I absolutely do agree with this from personal experience, what other people say, is the inflation rate that is currently going on, which is accelerating, uh, is higher than we are being told by the Federal Reserve. So the Federal Reserve, basically at multiple points in its history, has changed the metrics by which it calculates inflation. Okay. And that makes it very hard for continuity and to actually figure out what inflation is. Like if I can go, oh, we're excluding this stuff from our data set, it's like, well, if a bunch of people rely on that, then the inflation that affects them is much higher than this nice cozy number we have over here. Okay. So the CPI, the consumer price index, is how we used to calculate inflation. Okay. And that metric has been changed at a couple of points in time. But we can see the official CPIU is what, 4%. I think the Federal Reserve, last I saw, it was like 3.5%, which is still bad. The Federal Reserve targets like 2%. Okay, so even have 3.5 is scary. What's more scary is that growth. We're seeing it go from essentially 1 to almost 4 already. Now, maybe we had updated figures that said, yeah, it's actually 4. That's already bad. Okay. And what this article is arguing is basically a older metric, I'm guessing, 1990 based. I'll read little bit about this. It's saying we're already at like 8%. I've seen some people that are PhDs say we're already at like 10%. And that is absurd. And everyone I know is too. Every time I bring up this conversation, like I leave out the numbers because some people don't like that stuff. I leave out the data, but I go like, hey, like, what do you think of how expensive stuff is getting? And people always tell me the same things. It's like, I had this double in the past couple of months. I had this triple. I've heard health insurance has doubled. I've heard gas prices have doubled, tripled in some places. I've heard groceries have gotten more expensive. We've had shortages. It's like, how do you make that more obvious that there is a very big red flag on the wall saying inflation is about to pretty much destroy everything if people do not make the right defensive investments? Okay. Anything, I'm a monetarist, right? I like Milton Friedman, I like free market economists, what have you. They say 0 should be the ideal. I agree with that. The Federal Reserve says 2. Okay. And you can kind of see, I don't generally agree with the Federal Reserve, but hey, whatever. You could see like certain periods that came close. Did not do a good job 2007, 2008, obviously. We went from relatively high inflation to super low, but it's like, look at this, right? That is scary. That should be scary. You should see this and go, yeah, I'm expecting everything to increase by 5% month over month. And it's going to get worse over the next 6 months to 2 years, right? Because they printed a stupid amount of money, right? It's crazy. Okay. So here we go. I haven't read a lot about this like alternative way of doing it, but yeah, so here you go. We can see year over year change through April of 2021. It's like it has been above 10%. And here's the thing is, I haven't checked this methodology. I haven't checked these numbers, but I've seen a lot of people online, even back in mid 2000s, like 2010s. So yeah, like the prices of this went up 5-10% over a year. Like burritos at one point were like $1 or $2, and now it's like they're $6 or $7. It's like that's more than 2% inflation per year. And I saw an article on that. I decided not to. Oh well, here we go. I don't know if I want to read this article because I haven't read it yet. This person saying revealing the real rate of inflation would crash the system. That's a bit extreme, but I mean, inflation is about to crash the system itself. So like, I don't know. Talks about the burrito index. I mean, that's just burritos. If you don't eat burritos, you don't have inflation. But they said that essentially, and when was this written? 2016, burritos were $6.50. And early 2000s, they were $3.38, right? And it's like, take McDonald's. I remember burgers were freaking cheap. And what happened is the price of burgers went up for a little bit and people complained. So it came down, but they gave you less burger, less quality meat, and essentially took off ingredients. So there's definitely hidden inflation, even if the price didn't go up. Now, the price for a lot of things absolutely went up. Why did they do this? One, lie about Social Securities. They pay out less benefits because that would bankrupt people, right? That would bankrupt the government. Um, and they would have to raise interest rates, which would also destroy the economy. Blah 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 blah. I don't want to read this because it's a little too extreme, but inflation is going to destroy the system. Okay, right. So the real year over year inflation has been steadily around like 4 to 6%. I absolutely, from personal experience, what I've seen other people say, can agree with that. Okay, versus like 2%. Medical bills, ridiculous. Car insurance, cars, ridiculous. Guns, ridiculous. Bullets, ridiculous. Anything made out of metals has been way more sensitive to inflation. So think about that. It's crazy. Okay. So what do you do? So actually, I'll go to that in a second. Excuse me. I know this is Reddit. They posted something they found on Bloomberg Terminal. And I saw a couple of different variations of this graph that left out some areas because I know some pretty big finance or economists tweeted one out, and maybe she used a slightly different formula that happened. But the big downturn was, I mean, we can still see it here, was the 70s. And here. And look, right? You can see it falling off a cliff in what, 80s? Yeah, so this was one. There was another one in the mid 70s. Almost touched it there, almost touched it there, almost touched it there. And what is that? That's 2007, 2008, right? We're seeing it lower already than some of the previous recessions, right? 2001 tech bubble right here, 2007, 2008 right here. There was there was a recession early 90s. I'm not sure about mid 90s. Maybe that was, or 80s, excuse me. That maybe that's the flash crash. You can see it rebounded. And then we had one 1980 that was very bad. That was when the Federal Reserve had to push interest rates up because they messed everything up. Which, hey, hint, hint, that looks very similar to now. And we had the mid 70s, which was wind down of Vietnam War. So doesn't necessarily fit one for one here because, well, I mean, we've spent a lot on war in the past two wars. So go figure. Maybe that is similar. Once again, huge decline, very quick decline, hits negative. Almost all of these, if not all of these, was a recession. We're in negative territory, and it's not going to slow down. You're going to see it get as bad as, if not worse, these two periods. And this was a very, very, very in general bad time for the country. Stagflation, gas lines, inflation, economy turned south, people were losing jobs. There is a way to avoid this. There is a way to not get screwed and end up waiting in bread lines, because I think it's going to be worse than the 70s. Once again, what did people have to do in Weimar Germany, Venezuela, the Soviet Union when this stuff happened? You were waiting in bread lines. That is coming to America if you do not make defensive plays. Okay. And it's, you can put your head in the ground, right, and be like, oh, like I don't think that's going to happen. Or you can read the very obvious writing on the wall. And I'm trying to get that exposure. Okay. Plenty of famous people have, which leads into my next topic. One of the things I wanted to talk about in this video that essentially got removed off the internet was Michael Burry. Now, generally speaking, I try to shy away from just kind of casually throwing out big people's names because a lot of them are charlatans. Michael Burry, however, correctly called the 2007-2008 mortgage crisis. He was one of the major kind of people in The Big Short that has Michael Bale, Steve Carell, all those people. Who cares, right? He definitely got very famous off of calculating the numbers very solidly and essentially putting puts on the US real estate market. Okay. And people hated him because for a while he had lost a lot of money, but he knew that like once that date comes, that the economy is a house of cards and is very quickly going to crash. He made, I believe, billions for his hedge fund and probably made a lot of money himself. Now, that was it. his fault that he was betting the economy was going to implode. The economy was in bad shape because of terrible financial and fiscal. I mean, that is fiscal and monetary management. Okay. His Twitter got shut down recently. Okay. He was tweeting supposedly very cryptic stuff. However, one of his tweets was he posted a list of his positions in his portfolio. Okay. He removed the dates so like people couldn't copy him. Okay. I mean, granted, you probably could do them a year or two out and you pay more money, but you'd have the same positions. Some of his plays were the US bond market getting screwed. Okay. The yield curve on bonds, and this is a good educational opportunity. The yield curve on bonds gives you the yield on bonds by their time frame gives you what is called the US yield curve. Okay. So 1 month out, you get 0.01% if you buy a US Treasury that is 1 month out, right? 2, not much better. 3, blah, blah, blah. Okay. We get to 6 months, 0.04%. Yeah. So basically you buy a treasury bond and you get nothing. Especially if you subtracted the inflation rate in this column, it'd be negative. It'd be highly negative. Whether we take the official Federal Reserve's 4% interest or 4% inflation or 10% inflation. Okay. I mean, if we take either of them, well, these are all negative completely what the inflation rate is. The real rate of return on these bonds is negative. It's crazy. Okay. And this is what that guy talked about in his article about the economy basically heading for disaster. And I agree with that. We have all of these less than 1% and basically close to zero. And this is what a lot of people have pointed out over time. That's not good. The 3-year, so 12 months times 3, so 36 times, So the 3-year, excuse me, I'm trying to go through a lot of data here. The 3-year, okay, treasury rate. So I go online or I go to a broker, or I just go straight to the Fed or big banks, buy a 3-year treasury bond. Okay, so 3 years from now, I get the bond back with a certain amount of money and I make some coupons along the way, right? Still close to 0%. Yeah, good luck with that. Okay, what is that? 5 years? 5 years out, still less than 1%. Okay, and after inflation, heavily negative. Okay, and inflation is only going to pick up. That minus will be zero at this point. 84 months is what? 7 years? Barely over 1%, which is crazy. If you look at the historical trend, it's changed a lot from different periods, but like ideally, I think most people say the economy does well, like with short term maybe being 2 to 4, midterm being 4 to 6, and maybe it kind of levels out around there. It's been different in different periods of time. However, when interest rates are this low, you're looking at mega inflation, especially with the amount of money that's been printed. Okay. Even like, what is this? 10 years out, 1.5%. That's ludicrously low. Ludicrously low. Now I plotted these. Okay. And I can't say it looks as flat as I would like, but what people normally do to plot it is they'll lop off the 30-year because that's always going to kind of make it look flatter with that big period of time. And I mean, I rarely see people put the 20-year as well. Usually it's the 10-year or the 10-year and the 2-year. And like sometimes they'll have say 6 months in there. Okay. So what would 10-year be in this? What's 12, 120 months? So where's 120? 120 is what, right here? So 10-year right there. What's the 2-year? 2-year times 12 is what, 24? 24 would be right here. You would draw a line right there. That's looking pretty darn flat. Okay. So it looks less flat if we include all the points. Most people don't, right? So the 10-year right here, and the 2-year maybe about here, I think. No, right here. Look at that. I don't have like paint, but that is flat. And when the bond market is flat and then becomes inverted, you not always, but often have a recession. Okay. So it's not the best indicator. I think one of the memes is like, or the sayings is economists have correctly predicted the last 10 out of 2 recessions. So they overpredict using this indicator, right? But this indicator often will invert, and I think somewhat gauges the severity of what's going to happen in the bond market. Okay. So here's my follow up is Michael Burry posted a tweet of his positions, and he essentially went, if I recall correctly, short long-term bonds, and he might have gone long short-term bonds because they're going to have to force it up. I could be wrong on that, but I know he basically put bets that the bond market was going to get absolutely screwed. And for all intents and purposes, from what I've seen, I agree with him, right? Now, he probably was better at calculating dates because he said foreclosure rates on mortgages are starting to pop up. Just like in 2007, 2008, we're going to see car loans pop up, personal loans pop up, credit card loans pop up, right? So he's playing bets that the debt markets represented by the bond market are going to get screwed. And the Federal Reserve probably will have to raise rates because they can't go any lower. If the Federal Reserve, and I could be wrong, they could take them lower, they could go negative. Well, what's going to happen is people are going to take all that money out. I mean, people are already probably taking their money out, regular investors, because this yield, right, is ridiculously low. Why would I buy a treasury bond for what, 60 months from now? So what, 5 years at less than 1%? That when after inflation, it's negative. It's like, this is screwed. This is, I don't know what to say. You know, this is the most dangerous economy phase we've been through in the history of America, period. In stock, right? The bond market is going to get destroyed. As a result, it is probably going to drag down large segments of the stock market. Okay. Hyperinflation is going to take off, and everything's getting more expensive by the day, probably by the month. This will probably happen within the next 6 months to 2 years at the latest. And I generally put it by the end of the year, maybe midpoint next year. Don't know what to tell you, right? COVID's generally over. People are getting out. People are spending more money. When that happens, all of that money that the Federal Reserve has given to big banks and big businesses for free, they are going to spend it. That is the velocity component. The money amount is super high. The velocity is going to pick up, and price level and some other variables equal that. You're going to see prices, and they are already starting to happen, go through the roof. It's that freaking simple. Okay. So, yay. Right. I think I talked about this already, so that's good. I talked about Venezuela. I wish I kind of had Michael Burry's tweet of his plays, but he bet that the stock market, the bond market's going to get screwed, and the stock market's going to take a hit. Excuse me, not to hint. It's going to take a hit, a big hit at that, mind you. So I'm done with this. Let's talk about this that this person found. I definitely want to check this number out, and they overhyped it somewhat. I probably, and I would check this because I'm not sure I've seen this recently. Maybe the relationship has somewhat lessened, but it's still probably very much occurring. Okay. So here's the issue. Let's tie all of those strings I just talked about together. Okay. We're looking at possibly, most likely, the worst financial crisis in American history and probably the world. Except, okay, the bond market's going to get destroyed. Stock market's going to potentially get destroyed. It's going to get destroyed. Okay. Commodities is not going to get screwed. Could take a hit for a little bit. Okay. Inflation is going to pick off. All of these are recipes for a disaster. Okay. What are the defensive plays in this situation? That is key. That is the most important question we can ask ourselves in this video. Okay. What are the plays? Well, houses typically hold their value in inflation. However, the housing market, a lot of those bonds are going to get faulted on. So that's probably a hard one to play, but those do survive inflation. They don't necessarily survive a major market downturn, especially when there's a lot of debt being defaulted in the housing market. And Michael Burry shorted that again. Okay. So you could do houses. Sure. Maybe. Debatable, in my opinion. Okay. The stock market, most of it's going to get wiped out. And that kind of comes to this article. What they found in this GameStop Sega episode that's kind of still going on is GameStop, AMC, BlackBerry, Nokia, and Bed Bath & Beyond. There might be like one or two others in there, but it was mainly GameStop and AMC. Have a very high negative correlation to the rest of the stock market. What is beta? Maybe not correlation, but beta. What does that mean? That means that when GameStop goes up and AMC goes up, and they pretty much go together because they are highly correlated to each other. When AMC, GameStop, and these other 3, 4, 5 stocks, which were heavily shorted by Citadel, go up, the rest of the stock market goes down, and vice versa. So when those stocks go down, the rest of the market goes up. What does that mean, right? So that means Citadel, Melvin Capital, and some other hedge funds were heavily short those stocks, naked shorted. And since Citadel was heavily involved with these dark pools of money, right? That means that essentially the entire stock market, and I think there's one or two other stocks which I'll talk about, the entire health of the stock market is reliant upon these 5 stocks, okay? Because they were so shorted by these hedge funds with billions of dollars, okay? Which is absolutely crazy. That is a house of cards by no stretch of the imagination. And I've talked to people, just not a financial advisor, but I talk to people like, hey, look at GameStop, look at AMC. And what Deep Value, Roaring Kitty, basically that whole Shabakal showed, is the actual value of a company in this sort of market doesn't matter. I mean, God bless my pops, but I'm like, hey, GameStop, AMC. And he's like, oh, like I'm going to be in these stocks because they have a good business. Doesn't matter. We are in the bubble of bubbles that when the economy turns south, large swaths of the economy, including some good businesses, are going with it. Why? Because AMC, GameStop, and these other stocks determine the like how the market moves. So if they're not moving with GameStop or AMC, the stock price is going to take a major hit. The business could potentially go out of business, even if it's a good business. Okay. Because a lot of retail investors took all their funds from these other stocks and went into GameStop and AMC. Rightly so, right? Because they're naked shorted, and these hedge funds are going to have to pay those people billions. Okay. So my concern is I talk to people and I have a lot of friends that are like, oh, I really like Tesla. I really like this stuff. Tesla's heavily shorted. I think a lot of hedge funds recently went long. I might have that backwards, but I know Michael Burry bet that price is going to go down a lot because those hedge funds are long that and short GameStop. So when GameStop goes up, Tesla goes down. Yeah, right. So it's the whole stock market at this point, to anyone that's been following what's going on, is heavily manipulated. It's all fake. Okay. And in that context, it's whether you invest in a good business or not, doesn't matter. 0%. You could be in the world's best business, and it's like you're facing disaster. Okay. The only moves in this economy that will save you, right, from dying in bread lines in the winter, right, or in the cold if you're up north or what have you, right? Or burning in the summer heat down south, right? The only moves in this context, okay, the only ones are GameStop and AMC, okay, which I'm not in those. I know a lot of people that are. That's fine, right? That's their choice. Silver or commodities, okay. So JP Morgan heavily manipulated silver down and gold, right? So that's kind of in the commodities group, but silver is the cheapest of that group, okay. Gold will probably go up too, but silver I think is the more accessible trade for most people. Okay, so JP Morgan is in the same situation as Citadel and Melvin Capital. They shorted the silver market and manipulated silver, gold, and other commodities. Okay, and so have a lot of big European banks. When they finally have to buy back all the silver that they shorted and fix the market for its fair value, which is what a lot of regular people are doing, they are going to have to buy back a ton of silver. The price of silver is going to go very high. I don't think anyone has a good accurate measure, but it's going to the moon, right? JP Morgan is a big Wall Street bank. They probably will go out of business, right? Or close to it. Probably out of business if I'm being real. Okay. What does that mean for the economy? Like a big bank that's worth like $500 billion going out of business because they got greedy, that's also going to take out a large chunk of the economy. So it's like, oh boy. And I personally think that silver is going to cause like more benefit for the people in silver, but more issues kind of for the economy overall. Now, I'm not saying to not stack silver. I say stack it because JP Morgan manipulated it. Screw them. They have $500 billion. All right. Everyone that has silver, that has physical silver, PSLV, in my case, SILV, which I think is the best play in this area, is going to get some of those billions of dollars. Right? Screw JP Morgan. They caused it. It's not us, right? And same thing for GameStop, AMC, Melvin Capital, and Citadel, right? Equally valid plays. I think silver is going to get more money because of JP Morgan and these other big European banks being short silver and lying about it, I might add. So I think personally a good diversified portfolio, but I'm 100% in SILV, Silver Crest Metal Inks. I think a good portfolio, right, in this economy where everything's more or less going to be wiped out, except for the people willing to go, yeah, I need to be in these boats that are going to take me to safety as the rest of the world gets wiped out, right? The plays, I think silver is the best, personally. I know a lot of people would disagree with that. I like SILV. There's people that disagree with that. That's okay. I like SLIV. I'm going to go ahead and post my research. By the way, I just saw that there's some bad words on the screen. So I don't know if I'm going to get banned by YouTube for that. My bad. That's this person's fault. So yay. Thanks, dude. But yeah, so someone talked about if GME moons, there's a stock market crash. Also, same with silver, right? And if one of those goes to the moon, it's probably going to cause the other one to go to the moon, which is crazy because that's how fake the market is at this point. Regardless, sorry for that bad text on screen. Don't read it. I thought they were posting legitimate research. I know someone did for the beta of GameStop in the market. That person was using some bad words. What was it? So I think a well-diversified portfolio, although I am 100% in SLIV, quite frankly, there's no such thing as well-diversified portfolio in the stock market, right? People might buy SPY or ITOT or IVV, right? And it's like, oh, I'm diversified across the whole market. I'm safe if any of these companies go out. But yeah, a lot of them are going to most likely go out, right? So the issue is people are afraid to be like, oh, I'm going to be in one or two stocks. Okay, fine, right? You're afraid to be in less than one stock. Okay, right, here you go. AMC, GameStop, BlackBerry, right? Probably maybe Nokia, Bed Bath and Beyond, right? 5 stocks, right there for you. Okay. In terms of hedging that portfolio, right? And this is where I am. Silver, physical silver, PSLV, and in my case, my favorite, my one is SILV, right? Silvercrest Metals. You now have a portfolio that is protected in most situations from the absolute shenanigans and insanity that's going on in this economy, right? So once again, I'm 100% in SILV. I will be publishing that research very soon. I'm just trying to finish up the numbers as quickly as possible. But it comes down to this, two segments of the economy, silver and commodities, probably gold as well, heavily manipulated by one big player in the industry that screwed over Americans over the decades. In the other sector, you have a couple of stonks, as the people call it, that were heavily manipulated by another hedge fund, probably worth billions, or another big player, not a bank. JP Morgan on one side, Melvin and Citadel on another, hedge funds in a bank, manipulating two sectors of the economy. That means the entire economy is messed up, right? Because the only other sector is bonds, and it's like the Federal Reserve guaranteed that was going to be screwed and very fake and cause inflation and screw everyone over, right? So there are only a couple of ways to survive the coming the apocalypse. Screw it, right there. I said it. The only way to survive what will probably be the largest economic downturn is what I just said. A couple of stocks. In my case, I think a better play is SLIV for silver. Okay. If you don't make those plays, then, don't know what to tell you. Good luck. See you in the bread lines as I ride down my Lambo in the street. So gonna go ahead and say that's the end of this video. I have to say legally not a financial advisor, but I am very good. I'm not a financial advisor. I can't officially make any stock recommendations. I don't get paid for my services. I do this for fun and education. So you can learn about what's going to happen as well as how to handle these situations in the future for your friends, family, and community, right? Regardless, okay, I'm not a financial advisor, SEC, lick my my bee's knees, as I'll call it. In this context, I'll say this, I'll finish up and say this. You shouldn't be afraid about the future. The moves to protect yourself and your friends and your family are very clear. That's all, right? I just said what those moves are. You could check out reddit.com/rsuperstonk, I think, for GameStop. AMC, I think, is a separate subreddit. You can look that up. Wall Street Silver for silver. Okay. And there's also Occupy Silver, and there's another one that are on Reddit. And a lot of those posts are memes and not people necessarily contributing research. That's fine. There should be tabs on the top for research. I'll say this, I'm 100% in SLIV. We're already seeing silver shortages. What happens when physical silver runs out? People turn to the miners. The only miners that will remain out of the sector of silver miners are ones that are currently in good financial standing, which I believe is SLIV. And I will be releasing and reviewing my research in the next, hopefully, week or two. There's not a lot of time. I think the world as we know it is coming to an end 6 months to a year and a half, maybe 2 years at the latest. I don't see 2 years, 6 months, maybe less. Any time from now to a year and a half from now, the economy is going to explode. If you don't accept that fact, you're screwed. So read the warning signs, start learning this stuff. If you don't understand it, look up terms that you don't know. Like, prepare yourself, right? Learn for now, make defensive plays for now, study, learn for the future. So if there's ever this bad mismanagement of the economy, you don't suffer while big banks get bailouts. Okay. Right. That's as simple as it is. Okay. And my message, I know I'm being a little you and being aggressive, but it's like, no one can paint this picture this clear. Okay. It is clear. The writing is more than on the wall. It's like, it's in your face, right? It's like, right? Don't bury your head in the sand. Because if you bury your head in the sand and you ignore these facts and this data that paints a very clear picture, you suffer, right? And it's that simple. And my concern is people like my dad, who I love, is just like, oh, I'm going to just keep investing in good companies. And it's no, there's only a couple of businesses and stocks and commodities to invest in that have a 99, if not, I don't want to say 100, because there's always that statistical anomaly, but it's they have a 99.99999% of making you a lot of money. I guarantee you, by in the next 2 or 3 years, by investing 100% in SLIV, I will be a multimillionaire. Ayo. Right now my investment is down 50% and it's in the red heavily. And it's like, I don't care. I'm just holding, and I know that I will be a multimillionaire, if not a billionaire. But here's the catcher: is like post-inflation dollars, I'll probably be like 100,000 I mean, we'll see, to the moon, hopefully. So stay tuned for my research and talking about that. But at the end of the day, you got to start throwing some very brave darts at the board if you want to benefit from survive and thrive, and benefit from the terrible mismanagement of this economy, the finances, the fiscal, the monetary policy, right? So it's time to make a stand. And I'm going to live or die with this stock. I will not be standing in bread lines and playing around with money in the streets and burning it in chimneys and whatever, right? Which is what they did in these hyperinflation countries. It's time to stand on your feet and live or die on this very fake economy. It's that simple, right? Screw the mom and pop stocks for now, right? Once GameStop, AMC, and Silver and SLIV go to the moon, all those businesses can be looked after, right? But right now, all of those are heavily shorted or longed by these big banks and these hedge funds that you don't want to play into their hands, because they are getting taken down by Silver, by GameStop, by AMC, right? Probably gold too. And the inflation is not going to help that at all. So that's what it comes down to. Good luck. Read this video, check the numbers, start see what people are posting on the Reddits that I talked about. I don't know what else to tell you. Hopefully you watch this video and the picture is clear that this is not the time for people to be comfortable with what's going to come, I guess. Share this video, please. Learn from this video. I don't make money off of this, not a financial advisor. I'm just telling you what seems very apparent to me, and a growing number of people by the day, and a lot of good investors, like Michael Burry. Once again, don't necessarily want to give a shout out to famous people, but he made some tweets that were kind of it's not looking good. So I don't even know how to end this video, to be honest with you, because it's that is a doom and gloom, perma bear, as people like to say, situation. But that's the sad fact of the matter. Okay. So, hey, save yourself, save your friends, save your family, spread this video. I don't make money from it. I've been trying to tell my friends and family about this in my Twitter, which I'm not sure if I linked on my profile, but same name, Wobbly Giraffe. Hey, good luck. I'm doing this because I want you to have the best time of your life, and you can make money off of these plays and have a great time, or you can wait in the bread line. It's that freaking simple, right? The choice is yours. So good luck. Have fun. SLIV to the moon, right? Not a financial advisor. SEC, suck it.